makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London, standing in for Francine Lacqua. Here's what's coming up on today's program. Oil pushing closer to that $100 a barrel mark, driving expectations of those higher for longer interest rates and keeping pressure on global markets. Germany's bellwether state sees a softening in price rises with national numbers expected to follow suit. But on the other hand, Spanish CPI, that's accelerating for a second month, highlighting the difficult job the ECB is facing. Plus, Italy's government sets up a potential confrontation with Brussels, delaying its deadline to meet the EU budget deficit target by at least a year. Let's take a look at the European markets map because, look, there are a lot of different geopolitical cross-currents. The Asian session largely in the red. In the European session, not so much. You are seeing some underperformers in the FTSE 100, down about 0.4% over here on the island. But if you actually do look across the continent, seeing a little bit of green on the screen. But this isn't one I would call that has a lot of momentum. Take a look at the FTSE MIB in Italy, higher by 0.2%, the same margin as some of its other peers. The DAX, on the other hand, virtually unchanged, which is interesting because we are still getting that Germany Brandenburg CPI numbers right now for the September reading, a 5.6% increase year over year. Again, no major movement yet in the DAX, pretty similar to what we saw in that regional data this morning as well, but certainly one that we're going to keep an eye on very, very closely. Let's talk about the major story in markets, which of course is going to be oil marching towards $100 a barrel. And it really comes down to this dynamic, specifically in the United States. It's going to start pushing prices up on this side of the world as well. It's in WTI. Now, we're going to get a little nerdy. Stick with me here. We're showing some backwardation, and that's what this spike here really indicates. It basically means that the contract right now is far more expensive, far more pricey than the second contract. It basically means there's so much demand for right here, right now supply, really an indication of that physical market tightness. And that's why you're seeing such a spike. It means that need for oil right now is getting more and more intense. At the same time, we're talking about what that means for fiscal budgets around the world. Japan, the United States, even right here in Europe. We're talking about Italy, of course. That's going to be a big piece of their equation as they delay their meeting of the EU's fiscal limit requirements. Going to get a little bit more analysis on that in just a moment. But for now, what you need to know in terms of the market reaction is that the spread against Germany widening 30 basis points in September alone. That's what this spike is all about. I'll give you one more spike to keep an eye on, and that is going to be the Bloomberg Dollar Index, because that is on a tear. You're continuing to see some real weakness in the pound, in the euro, in the Swiss franc as well, all pushing the dollar higher and higher, not to mention the Japanese yen. But what it's doing in return is some of those European currencies are indeed in oversold territory. So that's going to be something we watch very, very closely. Joining me now for a little bit more economic analysis, Janet Henry, Global Chief Economist over at HSBC. Janet, pleasure to have you on the program. Thank you for joining me this morning. Let's start with the oil question first. $100 on the horizon. How worried should we be?
It's something we really don't need right now. But I think it's just one of the many factors in the mix. When we think about the impact of higher oil prices, yes, we are now at a level where they are higher than they were this time last year. They're still nowhere near the peaks that they hit in 2022. And a rise in oil prices impacts differently on different countries. In the past, you would get a rise in oil prices. People were spending more to fill their car with fuel. That cut back what they could spend on other goods and services. The economy slowed down. But the trouble with it happening now is that it's another factor that's likely to keep inflation higher for longer. And when it's already been above target for 3 years, it's much more likely to feed into pay settlements at a time when the labour market's still tight. So, yeah, absolutely still feeding that idea that maybe central banks haven't finished raising rates, and indeed even more likely to keep it higher. You can have a stagflationary environment. Growth can be awful, but inflation's sticky, and they still can't cut rates.
I mean, this was the lesson ultimately from the 1970s, right? That basically you keep going strong on the rates picture, even to avoid a second sort of uptick in the inflation number, specifically driven by commodities. Basically, that would be Powell and Lagarde's worst nightmare. Let's talk a little bit about the bond story, though, because when you talk about the market reaction, oil and bonds not on the same page right now, whereas post-pandemic, they used to be. Talk to us a little bit about bond yields and what they're telling you about the health of the global economy.
Well, it depends which part of bond yields
you
pick.
Take your pick.
Well, I suppose the market keeps thinking that this is a normal cycle. And that's where we've been now for about 2 years, ever since the Fed first started to raise interest rates. And then when we had the war, it was the US economy is going into recession. The consensus has been forecasting a US recession almost permanently since late 2022. It's only in the last couple of months that the consensus has said maybe we're not going to have a recession. Maybe we are in a different world. And I think we probably are. It may have been an aggressive cycle. It was short, but we are going to stay there for quite an extended period. This is another factor that's going to do that. And central banks, our next stage will be, even once they've peaked, if they have already peaked, is what at the pace that they're going to fall. Are they going back to zero? I don't think they are. Any easing cycle is still likely to be a lot smaller. We're not going back to a zero-rate world.
Well, it's not a secret here that we are in this kind of late cycle phase for the global economy, but it's almost interesting that we've been in this late cycle phase, I want to say for 2 or 3 years now. It's a really long late cycle. Talk to us about just how much longer that could be.
Well, it is something of a long, slow grind. For the last 18 months, nearly 2 years, I've been talking about the idea of a rolling recession, a partial recession. We know that there are signs of strain in every economy. In Europe, you're seeing rising bankruptcies in certain sectors. In the US, you are seeing certain income groups and households where credit card loans and auto loans, you're seeing delinquencies. You've got some countries in the world where they're tied to short-term interest rates. Consumer spending is falling sharply because they're spending so much. So it is a multi-year adjustment. So it's an extended period of very weak growth. We still have below potential growth rates, even in our 2025 forecasts.
I mean, a scary prospect to say, look, we've come so much from the pandemic, and even the lasting effects of that could be even more lasting than we thought. Look, we're talking a lot about the narrative around the world right now. It seems very binary. Recession, no recession. Inflation, no inflation. But then you have countries like China or even Sweden that are talking about a major property crisis. And I feel like when those headlines first came, there was a lot more reaction to it, a lot more sensitivity. Your take on the role of Evergrande, of China, what is the read-through into the global economy? Should we care?
Well, first, on the first point, you're absolutely right. It's recession, no recession, as though at least we've got a recession, we can expect rate cuts quite quickly.
Yeah.
The fact is it's going to be different. It is a different world that we are in. But on the property market story, and particularly in terms of the China story, we know for a lot of the last couple of decades, the property sector, it makes up such a big share of the Chinese economy, it drove a lot of the growth. We've obviously seen over the course of the last couple of months some more aggressive measures coming through on the housing market, but nothing like the kind of China broad-based policy stimulus that we saw in 2009 or 2016, which really floated all boats in the global economy. It will be, a bit like the Fed, watching the data. Does it show signs of stabilising? We know there need to be restructurings. We know there need to be asset sales. Does the economy need more to stabilise the property market in this multi-year adjustment and to deal with the local government indebtedness in certain areas? But other signs of the economy are showing some stabilisation. But China at the moment is not going to be the lift to the global economy that it has during periods of previous global slowdowns.
I mean, the easiest roadmap to your point to find that out is in the last global financial crisis, wasn't China's major infrastructure plan what ultimately helped the global economy to some extent? I think it was in, I want to say 2009, if I'm right. The sensitivity to China, has it increased or decreased since then?
It depends on the economy and which part of the economy.
All right, let's talk about the US.
The US, well, I think, in 2009, it lifted everyone. I mean, the US is a much less export-dependent economy. But in 2009, if infrastructure's booming, if property's booming, then all commodity producers benefit, all capital goods producers benefit in terms of their export growth. The new period that we are now in China, which is lower growth but also a different mix of growth, infrastructure's been doing OK, industrial production's been doing OK, but they may not accelerate very much. The kind of growth that China wants over the next 3 to 5 years is going to be much more service sector driven, much more high-tech driven, We keep hearing this story about electric vehicles and China being the world's largest car exporter.
Yeah.
The sensitivity to the world, the lift to the world, even if China does surprise from this higher quality growth story, it won't provide the same lift to the global economy than those previous periods did.
Yeah. You need the right concoction of growth.
You need to be exposed to the domestic economy if China does surprise on the growth side.
Certainly something I'm sure Europe will capitalize on if we start to see that growth actually come to be. Jana Henry, Global Chief Economist over HSBC, thank you for joining me this morning. And, of course, a reminder for you that the Berlin Global Dialogue Forum is underway. You can continue watching it on Live Go on your Bloomberg terminal, just LIVE Go. Stephanie Flanders right now hosting a panel with European Council President Charles Michel and Merrill Lynch International CEO Bernie Mensa. Plus, German Chancellor Olaf Scholz will be speaking to Bloomberg's Stephanie Flanders as well today at about 2 p.m. UK time. And tomorrow, Bloomberg's Danny Berger will be joined on stage by BlackRock CEO Larry Fink. Two conversations you do not want to miss. Coming up on this program, Italy risks a budget battle with Brussels after delaying its deadline to meet the EU's deficit limit by a year. We'll get you the details next. Stick with us. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Kriti Gupta in London. Now, Italy has delayed meeting the EU's budget rules by a year, risking a confrontation with Brussels. Italy is not the only country struggling to meet EU fiscal rules, but the plan does underscore the challenge Prime Minister Giorgia Meloni faces in balancing tax cut promises and souring economic growth. Joining us now for more is Bloomberg's Alessandra Migliaccio, joining us from Rome. Alessandra, pleasure to have you on the show. Let's start off with the budget itself. A fairly cautious budget. People were expecting the worst. Where did we land on that spectrum?
That's right. The budget is a very cautious, considering we were very, very much worried that there was going to be crazy spending because this is a political government, it's a far-right government, and they promised a lot to voters. But actually, I think they realized they need to keep it under control, but they can't do everything. So Finance Minister Giorgetti told us last night at a press conference, Brussels will just have to understand. And what they have to understand is that Italy will not be able to go under that infamous 3% limit for deficit until at least 2026. Previously, they had said they would do it by 2025. So when that limit comes back into being next year, that is going to be a problem. That's going to be something that Brussels is going to look at. Why is this happening? Well, of course, some of those promises they will have to keep. It is a political government, so tax cuts, help to families with, struggling with inflation. And then there's growth that is just not what it used to be. Germany's struggling, much of Europe is struggling, and Italy is feeling it as well.
I mean, it feels like the markets are also feeling it. If you look at the spread between Italian BTPs and German bunds already widening quite a bit just this morning alone, how concerned should investors be?
There's reason to be worried. It's not immediate. I mean, again, we were expecting worse. The government has actually been reasonable to a certain extent in what it's doing. But Italy has mammoth debt. We've known this for a long time. And the fact that they're going to have trouble, getting that deficit under control, and they're going to have trouble with the overall debt number, which is around 140% of GDP, it is concerning, for the future, because if anything happens to make the situation worse, and we know in this very uncertain world, all kinds of things have been happening of late, that could really be a problem. Italy could have trouble servicing its debt, and obviously that is something the market is looking at.
Bloomberg's Alessandra Migliaccio giving us that crucial update this morning. Thank you for joining the program. Now, coming up, the right kind of wrong, I guess. We speak to the author of a new book on why learning to fail can actually teach us to thrive. It's an interview you don't want to miss. Stick with us. This is Bloomberg. Some major pre-market action in the U.S. happening right now. Micron in the news, of course. We know in the overnight session after hours of the U.S. close, Micron Technology did report earnings that came out pretty disappointing. You're seeing some of those losses really accelerate in the pre-market. It was down about 4% after hours. Yesterday is now down about 5.5% today. Really at its core, predicting a steeper loss than expected. We know there has been a major glut in the memory chip market, and supply concerns switched into demand concerns, something you're seeing with some of its international peers like Samsung and SK Hynix as well. So as we monitor that stock, we will bring you the news there, but not looking great right now for the chips story. I think this is an easy transition to make. Look, failure in the stock, failure in life, I guess. Is there a right way to do that? Well, a new book by my next guest teaches us how to, quote, fail well and how it's an important route to success in life. I'm joined right here on set by Amy Edmondson, Harvard Business School professor of leadership and management and author of Right Kind of Wrong, Why Learning to Fail Can Teach Us to Thrive. And I've even got a little prop here so we can show our audience that you have your name on an actual trade book. It's very exciting. I'd like my name on a book. Look, when we talk about the major CEOs of the world, the ones that we cover, the helm of Microsoft, Meta, etc., there are so many of them who say, look, I dropped out of Harvard. I messed up my very first couple of projects. LeBron James, I never made the JV basketball team. I mean, things like that. It feels like to be successful, you almost have to fail. Is that how you characterize it?
Absolutely spot on. In fact, I would argue the most successful people in any endeavor, whether it's sports or science, are those who have very likely failed more than the rest of us.
I mean, what do you assign that to, though? Is it just a question of grit, then?
It's grit, but it's also a willingness to stretch. Right? It's a willingness to take on challenges in which you might not succeed. Right? If you only take safe bets, you're much less likely to fail, but you're also much less likely to achieve.
Well, okay, so some would argue that taking safe bets actually maybe makes you a little bit happier, makes you a little bit more comfortable. Is that a fair way to say maybe failure isn't all that good?
It is a fair way to put it, but I am not sure that happiness is the goal or comfort. In fact, I'm quite sure that comfort isn't the goal. I think we have to get comfortable being uncomfortable if we want to make real contributions and achieve and ultimately get the joy and satisfaction of accomplishing things that were hard.
How does time apply here? And I'm really personally asking this for my own sake, as you know, and as our audience will know, I moved to London about a month ago, and I'm very uncomfortable, as anyone would be, when they're moving countries. What is the appropriate time for that to last?
It completely depends on the task, right? So if you're a scientist trying to come up with a new therapeutic that cures some rare disease, you're going to have to be patient for a decade. Right, because that's about how long it takes to go from bench to bedside. If you're a new Londoner, I think maybe a few months, you'll be good to go.
I mean, I'm gonna hold you to that, because the minute the clock turns, I'm gonna call you and say, look, I'm still struggling. I mean, argue against your own argument if you can. What are the exceptions to the rule there?
Absolutely. So, I mean, people ask me this all the time. Well, where is it not okay to fail? And I am absolutely committed to preventable failures in contexts where the stakes are too high. Right? So the first thing you need to do is say, what's really at stake here? From a safety perspective, economically, and reputationally. And if those stakes are high, then you do everything you can to follow best practices, not take excessive risks, and make sure to succeed at what you're trying to do. But when you're trying to discover new things, achieve a goal that has not yet been achieved, then you're in new territory. And when you're in new territory, you have no choice but to fail. So you have good reason to believe it might work, right? You don't go out in a foolhardy way saying, let's just fail today. You say, I think this might work. But you're well aware that it also might not. So the intelligent failure is the kind that takes place in new territory in pursuit of a goal with a good reason to believe it might work, and it's as small as possible, just big enough to get the learning that you need to advance further.
Do you have a favorite failure story of your own, or of a celebrity or someone you follow, one that you really kind of keep close to heart?
Oh, that's such a good question. I guess I'll share one of my own, because I was a PhD student with a hypothesis that said simply, that better healthcare teams would make fewer errors. And my data, once I finally had it, suggested that the exact opposite was true. I had failed miserably. I had a statistically significant relationship between teamwork and error rates in the wrong direction. Ultimately, the data were actually far more complicated than that, and what I had really discovered was that there were wild differences in terms of people's willingness to speak up about error, which ended up being a far more interesting finding. So that failure led directly to subsequent, at least, academic success.
Yeah, I mean, it makes a lot of sense. One of my very first bosses at Bloomberg actually encouraged that. I started on the analysis side, and he would say, look, you need to go out into the public, you need to explain why your thesis, your investment thesis was wrong, if it is indeed wrong. And then that ended up creating a lot of confidence in how to view the market. So I completely understand what you're saying there. Amy Edmondson, we have to leave it there, but I mean, a fascinating conversation, because to your point, we see it a little bit of everywhere, from the C-suite all the way down to even newbies just starting out. Thank you so much for joining the program. She is the Harvard Business School's professor and author of Right Kind of Wrong. I have the book right here. You have to check it out. Why Learning to Fail Can Teach Us to Thrive. A quick check before we say goodbye on the markets here. Micron, of course, still selling off. You are still seeing pain there, down about 5.1%, trading about $64 a share. This comes after, of course, the earnings yesterday in the U.S. session, after-hour session, disappointed to a pretty big degree. We will keep you updated on that slide as we get it. Coming up on the show, the UK party conference season is upon us. We dive into the details. This is Bloomberg.